Two Bowls in a China Shop is brought to you by these great companies that are giving us money to let you listen to their stuff.
Bullshit, Kyle. We make this show. You and me. Two Bulls in a China Shop is brought to you by us.
Someone's got to pay the bills, Dan, because it's not our trading.
All right, roll them.
You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face. Hello, everybody, and welcome to the China Shop. I am your host, Kyle, and joining me, as always, for today's midweek update is Erik from ES Invests. How are you doing today, Erik?
Great.
All right, but before we start talking about the news today, I'd like to just take a quick moment to say thank you to our sponsors and friends over at Manscaped, Trade Pro Academy, and Orderflow Labs. Manscaped is the best in men's below-the-waist grooming with precision-engineered tools for your family jewels, and with the new and improved 2.0 version of the Weed Whacker now available, it's the perfect time to take advantage of our exclusive offer of 20% off and free worldwide shipping using promo code 2bulls at manscaped.com. As always, that's the number 2. And when it comes to institutional quality trading education, look no further than tradeproacademy.com. In a free Discord server, you'll find instructions to take advantage of our discount with them as well. And for all you D-Gens who enjoy trading futures, you'll definitely want to check out the custom tools and studies over at Orderflow Labs. And anybody who's not following Erik yet on Twitter or YouTube or OnlyFans, they need to jump on that train. Get some of the best related market content out there.
We're going to have to be careful about the OnlyFans thing because it's only a matter of time before like a bot. I don't have one like on a for real note. There's going to be a bot that there's going to be a bot that makes one.
What am I watching then?
Well, those are just messages, Kyle. That's just, it's called a DM.
They're not your feed?
Yeah, dude. Oh, those are my dog's feet.
Oh, God. All right. Then lastly, be sure to reach out with your suggestions, corrections, or questions for future guests. Do that via email at twobulls@financialineptitude.com. You can join that free Discord server where a bunch of amazing people gather to share our struggles and lessons learned with other like-minded market aficionados. Put all those links in the episode description as well. Speaking of corrections, I actually got one from Robert. He informed me when I could not remember who the largest bank failure was. It was actually Washington Mutual in 2008. That is actually a bit of a segue. We were talking about SVB last week with Sue Mackey. But with all the banking turmoil that's been going on this past week, I feel like that's probably where we should kick off today. So, Erik, you've been paying any attention to what's going on in the banking world?
Yeah, the movement's been really fascinating. I had a couple pairs trades built out and whatnot. I've been trading a lot of the movement.
Mm-hmm.
But I do have to say the Credit Suisse stuff today and whatnot, that was a curveball. I didn't expect that to unfold. So
what was the deal with Credit Suisse? Was it just because their largest investor just decided to not invest more money? Is that the only reason, or is this all the other stuff that's been going on with them?
Yeah, I think there's a lot of history, which I'm still learning about. And I think it's dangerous to go too far on partial information. But essentially, the Swiss National Bank said it could provide some assistance to Credit Suisse if needed. But like the fact that there's even that kind of dialogue starting to emerge is a bit of a problem.
Right.
So
I did find a summary of the scandals that have plagued them in recent years. So this is going back. Let's see. In 2020, they hired private detectives to spy on former executives, led to the departure of their CEO in February of 2020. They lost nearly $6 billion in March 21 after the Archegos Capital Management imploded and defaulted on its loans from the Swiss lender. Still trying to recover about $2 billion of the roughly $10 billion it had tied up in that whole Greensill catastrophe. They were fined for making fraudulent loans dubbed tuna bonds to Mozambique's government between 2012 and 2016. The chairman was forced to resign in January after internal investigation found he violated COVID-19 quarantine rules to attend Wimbledon, and the previous CEO has resigned for personal health reasons last July. So a lot of turnover and turmoil at that company.
I cannot say that it surprises me.
No.
I think the thing that surprises me is that we still continue to be surprised by them having problems.
Them and HSBC, and I think I saw HSBC actually purchase the UK arm of SVB.
Yep. And then what is it? Douche, however the fuck
Deutsche.
you say that. Deutsch, the douche bank. Listen, man, we speak American out here.
You just want to say douche.
But yeah, we're starting to see the typical. After the past weekend, I thought this wasn't going to be the route we were going to take, and it looks like we are starting to go down that route, which is just very entertaining to me.
The route of calling Deutsche Bank douche bank, or the route of bank failures becoming a thing again?
Both.
Ah.
Yes. Both of those.
That's kind of scary, though. I mean, 2008 was not a fun time to live through.
Concur. And I think ideally, we won't necessarily go quite that far, but yeah, it definitely is not a super appealing turn of events, especially with what I was reading about Credit Suisse and the like the risk profile that they had. The SVB bank risk profile surprised me, and then it doesn't. It's just I don't know, man. Like I feel like we make the same fucking mistakes, and it just continues to chug that way. So I don't get it.
Right. Well, at least they're not bailing them out this time. I mean, that's I saw talking heads on Twitter calling for that, and I'm glad that they decided, at least so far, to not do that. It's good that they're making everybody whole on their deposits, but not protecting the people who, what's the word? Ran a company into the ground, basically, through poor risk management controls.
Yeah.
What was they were like really upside down on bonds, right? And I think now the question is like, how many other banks maybe are in the same situation?
Well, you mean SVB?
Yeah, yeah.
Yeah, that definitely was part of their issue was the bond position that wasn't hedged, and then there was a draw on liquidity. But I don't know the full picture. Let me see if I can find anything actually about Credit Suisse and see if I can get any detail on their finances.
I had something here. Let me see if I can figure it out. I think they sent out something about needing to raise cash or something, but where the hell is it? So the number one investor, as recently as last year, has already cut their entire stake over the past few months. They owned about 10% of them as of August of last year. They slashed it to 5% in January, and then recently reported that their holdings are zero now.
Right. And then did you catch the stuff on the Saudi National Bank?
Yeah, they warned they would not be able to invest more cash without raising its stake above the regulatory limit of 10%.
Yep.
So it sounds like they're using that as an excuse, but it doesn't say why they would want that now.
Why they would want what now?
Why they would need investors to be pouring more money into it.
It's the same. It's just kind of the same dialogue around SVB, man. Yeah,
Yeah.
like if people, I think people got a little bit sleepy and they forgot, that bank doesn't hold all the money and there is a liquidity problem. Like I genuinely think that's a big part of what we're seeing.
Yeah. Do you pay attention to credit default swaps?
I mean, I monitor them.
It's saying here that Credit Suisse was as high as 1,200 basis points on Wednesday. Good Lord.
The good part is it's a super tradable event. That's really been the takeaway for me. This is kind of exactly what we were talking about before we started recording. I think it's really interesting to understand the inner workings of these things.
Mm-hmm.
But I do think people get wrapped up around the axle about either one of two things happens. I think people either they spend all of their waking time attempting to understand all of the interdependencies and the movements and why they happen and coming up with a discrete story.
Mm-hmm.
Or I think the other scenario is somebody foolishly poses a really simple narrative that they think is what happened. And then they believe that that is to be true and they trade off of that.
Right. Yeah.
And I think both of those are super dangerous approaches to complex systems like this. And, like we're talking about for traders, I think it's good to analyze and understand how things work. It helps us with contextual understanding, but I think it is so important to compartmentalize the theoretical and more process driven understanding versus the practical application of the trading skill set.
The real danger is where you think that just because this event had this results, that the next time you see that event, it's going to play out the same way. And that's not the case because it's
Exactly.
not
Yeah.
that simple.
Yep. Exactly.
So you said, so are you actually trading on credit, Seuss? Because I didn't think you messed with penny stocks.
No, not Credit Suisse itself. Not yet, at least.
Okay.
So at the beginning of the week, I was trading. I really wanted to trade SVB. But,
I know. I
um,
pulled them up on Friday and was like, why is there nothing on there?
yeah, that real bummer that they couldn't turn the switch on for that.
Yeah.
Um,
No
but
kidding.
yeah, now essentially since they're dead, I was trading the other banks. So I was trading the total S&P 500 bank sector via XLF. I
Yeah.
was
Yep.
a mix between long volatility and short deltas. And then I actually had a handful of stronger entities within XLF that I was structuring pairs trades around. And then more importantly than all of that, and one of those that was just a really great trade was Schwab. I traded Schwab
Mm.
against the rest of the benchmark, and I had a couple others actually earmarked for me to kind of play an over exaggerated bounce play. So something like CME Group was on that list, and all I did this on a YouTube live session on Monday. I walked people through exactly how I thought about it. I literally just pulled up the heat map of the sector and I saw all of the red, and
Mm-hmm.
I looked at different names that were essentially counter trend. So as the market was like dying on Monday, well, the financial sector was dying on Monday. There was
Right.
still a handful of individual tickers within XLF that were holding steady.
That makes sense
Exactly,
because
and that kind of divergence is very tradable. So I was structuring stuff around that. So it was individual trades, but I actually didn't get as many names as I thought. We were going to start to see some better follow through. So like one of them was Goldman Sachs.
Mhm.
I actually thought that they were going to be one of the ones to pivot a little faster alongside Morgan Stanley. And both of those, I didn't trade them, but I had them on a short list because I thought I was going to trade them to the long side.
Mhm.
And obviously that ain't the case because they're still sucking wind.
Hi guys, Future Kyle here, sliding on into the mid rolls to give you all a sneak peek of next week's episode.
Let's roll into one of the problems that traders have that they don't know they have. I have never had a trader come to me and say, Rich, one of my biggest concerns is that I'm not going to be able to manage success, that my identity, my beliefs, and my behaviors just I've struggled for so long that I'm concerned that I'm going to sabotage my trading so I don't have to deal with a shift.
Mhm.
Nobody's ever come to me and said that.
That was a sneak peek of episode 6 of Trade Runners featuring Rich Friesen coming next week. If you haven't heard by now, Manscaped now sells beard products. That's right, once again revolutionizing men's grooming with the brand new Beard Hedger Pro Kit. From a beard trim to a fresh shave, the technology behind the Beard Hedger Pro Kit allows you to shape your signature beard look. Now you can finally use Manscaped products to make your drapes match your carpet by going to manscaped.com and using code 2bulls for 20% off and free shipping. God damn, I was going to make that joke. Our friends over at Manscaped were kind enough to send me the Beard Hedger Pro Kit, and I gotta say, I was impressed with the quality and performance of the products. My thick, coarse beard hair has been giving me trouble with trimmers in the past, but the Beard Hedger was able to cut through the thicket without any tugging or discomfort at all. And because the trimmer has one rotary wheel with 20 length settings with only one guard, I don't have to worry about losing or breaking attachments anymore. So I've tamed my mane, and now you can too. No one likes a weird beard, so say goodbye to your stubble trouble with Manscaped's Pro Beard Kit. It all starts with that beard hedger that I mentioned. The thing's a juggernaut of fixing faces. Not only does it have the trimmer with the rotary wheel that gives you the 20 hair cutting lengths on just the one guard, it's also waterproof so you can shave in the shower and avoid all the hair in the sink. The titanium coated T-blade is tough on hair but smooth on your face, leading to a single stroke efficiency that brings satisfaction one stroke at a time. Phrasing. The Pro Kit doesn't end there, though. They also created 4 dermatologist-tested formulations for your post-trim care. First is the Beard Shampoo and Conditioner. Gotta remember that all your hair is different. Beard hair, as I mentioned, is more coarse and easier to damage than the hair on your head, if you have hair on your head. That's why the kit has made shampoo and conditioner specially designed to moisturize, reduce ingrown hairs, replace natural oils, and promote beard health. Next, the kit has Manscaped's Beard Oil, an essential piece for your main facial accessory. No one wants a guy whose beard is brittle and dry. The oil relieves dryness both on the beard and the skin beneath while adding a little shimmer and shine, which makes you look extra fine. Cap off the kit with the Beard Balm, a pomade that shapes, styles, moisturizes, and tames for a sculpted look to attract any fellows or dames. The Pro Beard Kit also comes with 3 free gifts: beard brush, comb, and scissors to ensure your beard is ready to impress. So get 20% off and free shipping with code 2bulls at manscaped.com. Of course, that's the number 2. That's 20% off with free shipping at manscaped.com using code 2bulls. Manscaped Beard Hedger, 1 stroke, 1 guard, 20 lengths.
With any dream, the wind won't always be at your back. The sun won't always be shining, and some rain is going to fall. American Family Insurance is like a good solid roof that you can trust to protect your biggest dreams. With plans that could save you up to 23% when you bundle your home and auto. Also, you can continue to dream fearlessly, no matter what comes your way. American Family Insurance. Get a quote or find an agent at amfam.com.
Visit amfam.com to learn how discounts may apply to you. American Family Mutual Insurance Company assigned its operating company, 6000 American Parkway, Madison, Wisconsin.
Well, I mean, with all the turmoil that's happened with SVB, like Bank of America is one of the names that popped up on the story that I've got here. They saw an extra $15 billion in customer deposits recently.
People,
from the people getting
Yeah.
scared from their smaller banks and thinking that there's safety in the bigger ones.
Well, one of the things I was literally talking to my wife about, and like we have, quite a bit of money in like my brokerage account. And one of the things I was thinking about is, one, pretty good timing on moving some of that into commercial real estate, but then
Right.
two, for like the capital that still remains over the FDIC insured limits, like I literally started opening up bank accounts in the primary banks for the last 2 days because I need to split up chunks of $250,000 between several banks, right, to cover the capital. And I was like,
That's stupid, isn't it?
this is fucking crazy, man. Yeah, it's like,
Why we still stick to that? Like, what's the point of having an FDIC limit for per account if there's not a cap on the max number of accounts that you can have?
yeah, dude. I think it's maybe to spread the risk between different institutions. But
Oh,
the
does
other
it have
thing
to
is,
be at a different bank, or is it each account at the same bank?
that I don't know, to be honest with you. So I
Yeah.
purposely started opening accounts with different banks. So Goldman Sachs, Morgan Stanley,
Mhm.
and a few JP Morgan, and like 3 others. And the reason I was thinking is, even if it's FDIC insured, sometimes it can take a long time, right, for it essentially to pay itself out the way that we would want it to.
Right.
So you have the ability to at least ideally access cash in another bank if it's not also taken down. It just kind of spreads some of the risk. Yeah, man, like if the whole banking thing started to go down, it doesn't absolve all of it, but it just mitigates risk from at least a liquidity standpoint for me.
hmm Well, I like the concept, or what you're talking about with the trading, this being a tradable event. So, like, let's take a look at XLF because I think that one makes the most sense to take a look at. It's probably the easiest one to wrap my head around. Like, how would you structure a trade here to capitalize on this event?
I think it's late now if the
Yeah.
goal was to trade the initial move like I did and I wanted to.
hmm
But I don't think that it's completely past. And there's a couple things that I think can be done here. This is not where I would want to start getting long yet. I think it's a little too early. If I wanted to get long, I would do kind of what I was talking to you about before, where I would go through the different sectors and I would find the strength and I would trade the individual strong points.
hmm
But beyond that, for XLF itself, the kind of stuff I would be looking at is mostly centered around volatility because volatility is still very, very high.
Yeah. Yes.
So if we look at the volatility for today, the 15th, the 7-day vol is 40.5 5%, 30-day vol, same. 7-day vol for historic is 34 against 23 for 30-day. So what that means in a nutshell is implied volatility is tracking quite a bit higher than realized, even right
Okay.
now, even after everything that happened after that initial move. Because what happens in these kind of things is the market tends to be sleepy and we get this huge move. So on that first day of the catalyst, that's normally when you'll see realized volatility exceed implied volatility. Because, to say what I say to my dog, like, caught you slipping. But then from there, they start adjusting all their pricing models, infusing it with a shit ton of volatility because now obviously the risk is known, and then it becomes a volatility trade from. So that's the overall hypothesis. And I think there's a few ways you can trade it. The primary way I've been trading it is short DTE options, either in XLF or in something like well, I'm sorry, in like the 17 March or the 24 March, something like that.
Okay, so like in less than a week to a week out.
Exactly.
Yeah.
Really trying to expose ourselves. Really, that's the main idea, is to really try to expose ourselves to the shorter term movements.
Okay, so then are you shorting calls or puts, or do you not really care about direction necessarily?
Yeah, so it's either going to be straddles or strangles for something like this.
Okay, so more like an iron condor kind of thing.
Yeah, but except not an iron condor because I hate them.
Well, yeah, because you don't like the capped risk, right? Or capped
Yeah.
upside.
Well, it's also just because what I'm trying to trade in this scenario is essentially variance risk premiums.
Mhm.
And the very thing that I'm attempting to trade because I think it's overpriced, I essentially am buying it at the same time when I buy the wings. So if I'm really concerned about the risk, I would buy the downside wing pretty far out just to cap. But other than that, I essentially don't want to do that because then
Right.
it inherently disproves my own hypothesis.
Oh, damn. The 40 calls have crazy the implied volatility, but they also have zero price. All right. One of the other things that has happened with all this turmoil in the banking sector that we hadn't quite touched on yet. I mean, we had February CPI numbers come out. They were pretty much in line. But I've been watching that Market Watch calendar that you turned us on to, where you can keep track of the chances of a rate hike versus like what the expectations are going into the next FOMC meeting.
Right.
And it was super interesting watching the expectations for March go from basically expecting a 50 bip hike to now we're 50-50 over whether it's going to be a quarter point or hold flat and no hike.
Watching that evolve has been absolutely fascinating.
That and the December one, somebody turned me on to that, and I was looking back at the history on there, watching how like now we're predicting rate cuts down to what is it, 375 to 400 as the target rate. That's freaking nuts. So I guess the question is, did the Fed overdo it?
Too early to tell, man. But I do think, nonetheless, the Fed is starting to see some of the shit that they're breaking, which that in and of itself, I think is so important.
I wonder if that was like their strategy to start with. Like, we're just going to raise this thing up as fast as we can until something starts to break, and then we'll back off.
Maybe part of me does think that there's a breakdown with what they were expecting to happen and when. At least, yeah. I'm not sure otherwise, but to me, I am confused to see them. If you watch them speaking this past couple weeks,
Right.
they were seemingly surprised that this had started to occur, and to me, I just don't understand how you could be surprised about that.
I know, right? It's almost like they don't know what they're doing.
Right. Except they do.
They do.
And they're super fucking smart. So
it's just super fucking complicated.
Exactly, dude. Extremely complex system.
Yeah. All right. What else we got? Anything else we should cover before we wrap things up here?
No, man. I think I don't know if you want to let everybody know about the call that we're planning coming up to see if anybody has anything that they're interested in for that.
Oh, with an actual economist?
Yeah, with an actual economist.
Yes, coming up. Let's see, when are we going to record that? We've got it on the calendar for Tuesday, the 21st, at 6 p.m. So before then, if you can get us your economist questions in, we'll make sure to ask while we got shop favorite Erik Mason with us. Done a couple of recordings with him. He's just a fucking blast to hang out with. He actually said he was familiar with you too, and I'm not sure how that happened.
That's terrifying.
Have you talked to him before, or did you maybe just have some overlap with some of the shows that he listens to?
Yeah, I don't think so.
It's funny. I think the main questions that we're going to be asking and getting his understanding on is why economists don't trade, but happy to open that up to anything else.
Yeah, because I think this goes back to what we were talking about before, right? Like the two different brains that we can apply to the markets.
Yes,
There's an understanding and then there's a practical side. So I think this is a really interesting dialogue, especially because you and I have a little bit more of the practical side of things. That's definitely where I weight my time and effort. But it'll be cool to juxtapose that against more of a theoretical construction side. And obviously I don't mean the construction of a house.
Right.
I simply mean the construction and the framework of the markets themselves. So I think that would be a fun dialogue. And I think that there's a lot of really interesting topics that can be baked into that for people. Some of the stuff I fully intend to ask him wrap around finding that delicate balance from a trader's perspective, not from the economist perspective, but from a trader's perspective. Like, what are the no shit need to know economic data points and why?
Yes.
What's the easiest way to get them? You know what I mean? Stuff like that. Because I think that's like really elucidating information. I have a list that I've built over the last 16 years doing this, but I'm always still interested in that kind of information. So yeah, I think stuff like that would be really useful. So if any of your listeners, have questions like that, is a great forum to send them in for us to discuss.
I love it. You got anything else coming up that people should be paying attention to?
I did just launch a big old fat video on, it's kind of like an introduction to options. There's a million of them out there, and I'm not trying to redo what everybody's done, but what I did was exactly that. But
I love it.
my goal was to just apply a slightly different perspective where I offered the level of detail that I thought was important for beginners, probably a little bit more detail than some of the other videos I've seen of this nature. But my goal is for it to be like a reference tool for people.
Yeah.
So that you can kind of pull it up. It's an hour and 18 minutes long. I don't think anybody's going to make it through that whole thing. But
what'd you do? Read that book you're always holding up on the camera?
Yeah. It's, dude, if I read that book, I literally think the video would probably be like 20 something hours long.
It'd still be better than Yale's version.
Dude, yeah, I'm wondering if they have a derivatives market thing. That would be actually really, really interesting to see.
All right, let's go ahead and wrap this thing up then. It's going to bring us to the end of today's episode. I'd like to say thank you to everyone who stuck around to the end, and to Erik, of course, for taking the time to sit down and chat with us. If you'd like to know more about Erik, of course, you can visit his website at esinvest.com, and you can also check him out on his YouTube channel, the same name. Find us at twobullsinachinashop.com. Be back in your ears soon with another exciting episode, but until then, pillage that 5-star rating like it's SVB's assets, and take care.
That's a good one.
And then you're waiting for your buy. I got to get your buy in.
You've outdone yourself there.
That was a last minute one too.
Goodbye.
Bye, Erik.
In our Future of Cloud survey, Deloitte discovered two approaches to innovation. Those who look at the new technologies and changes swirling around them and wonder what's possible, and those who use cloud to engineer their possible, generating new revenue, advancing processes, and sparking cultures of innovation. Learn more about what separates these cloud innovators. Download Closing the Cloud Strategy, Technology, and Innovation Gap at Deloitte.com/US/cloud survey.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It It is only intended to provide entertainment about stocks and the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.
Also, I saw somebody in the company was under investigation for, I don't know if that was that Credit Suisse? Oh shit, I might have to cut that, hun. I don't remember.